Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow, here with our third quarter call, and quite a third quarter and 9 months this year it has been. Not that we didn't expect it, but it's been aggressive on the downside. Some things we think are going on today is that if you look at it, I think inflation became stronger than anyone expected in a short period of time. I also think that we're dealing with quite a few people, not only individuals, but professionals that have never been through a really elongated, tough market. And I think that the risk appetite of a lot of people has gotten skewed in the last 12 years because they've been used to a linear up market, nothing went wrong, everything was great, we plug and play and everything's okay. But let's take a look at the economy and what's going on there. Just today, the Purchasing Managers Index came out, and you can see it's been declining. And this is giving you an idea. What that affects are orders, it affects new buys, it affects imports, export, it affects everything in the manufacturing sector. It's becoming weaker as we go along. The other thing that's been happening, you've read a lot about it, but the dollar's stronger, obviously. And we pointed out some places here which you'll see where the dollar hit peaks. Now, we aren't anywhere close to where we were in the early 80s when they were tightening at that time. But that doesn't mean that we can't get there or we can't go higher on the dollar. I know a lot of people are looking any day now for the dollar to go down. But notice at the bottom how much the exchange area is involved with the dollar. If you look at denomination of dollars in trade invoices, obviously the U.S. is high, but look at the rest of the world, look at Asia Pacific. We're talking 70–80% of that is what's going on. The other thing I want you to notice is if you look at the National Federation of Independent Business, you'll look at the two graphs we'll have here. You'll look at sales. Obviously, they kept on declining through this period. And then secondly, look at earnings for August. And what this means is that they're pulling in. Just today, job postings really obviously have gone lower. Job openings are lower than they were. One of the things happening with individuals is this. They had saved a lot, they got a lot of free money during the COVID period, and the Fed unfortunately handled it wrong, and the government handled it wrong. But when you put all this money out there, the savings rate went up. We're now back to a 14-year low in savings rate. They spent all the money, is my point. And to notice and see how they spent all the money and what they're doing now, if you go and look at their credit, and this is not only buy now, pay later, but this credit cards, you'll see we've had this unbelievable increase. The largest going back to 32, 33 years in consumer credit. So that consumer is getting squeezed now, and you're really going to see that start up. And think about this, if that consumer all of a sudden loses their job, or one of the two loses their job, then you're in a different situation. You'll also see, and I think, and we said this too about 6 months ago, we thought real estate would eventually be one of the Achilles heels of the economy. And you'll notice here impending home sales are negative for the 12 months, and they have been negative for the last few months. We think that continues as you go along because there's so much at a high price and people got locked in and really bought in to the low interest rates. I can buy a lot of real estate routine. This is a graph we put together this week, but it shows housing starts versus houses sold. Now, if you look back at the last period, which was the 80s, it was tough to do a home, it was tough to buy a home during the early 80s and mid 80s. If you look now, we got up to about 3 times housing starts to homes sold. What does that mean? That means that, hey, you may not have had a lot of inventory before, but you're going to get a lot of inventory now as we complete those completions, but they can't sell them out. Here is one of the most telling things that I think is going to happen in the housing market. If you go back 20 months or so, and you take a $2,500 house payment, 20% down, you could have at that time bought a home in excess of $750,000, $758,000 this particular graph. Fast forward to now, same $2,500 payment, 20% down, you're only buying a home worth $476,000. That is a huge difference. And we'll have our market letter coming out in the not too distant future here, just a few days, and there's something we put in there about mobility. It has to do with the fact that if you're locked in to something really low and somebody has to buy your home or you have to go buy another home, it totally affects mobility in the real estate market. And we're just starting to feel that. We're not really into the heat on that, but we will be as we go along. So keep your eyes on that. Lastly, I talk a little bit about oil, and I know everybody got excited about oil, and we love, by the way, that was one of our biggest positions in the last 2 years. It hurt us a little bit in 20, but we made up for it in 21. And then everybody came into this year with oil, but now it's corrected. You'll see if you take the average monthly price, not the total perfect high price for the year, but June this year had the average highest monthly price. If you compare that going all the way back really to the last 40 years, every time oil has corrected about 60% from the high, which would put us at somewhere between $55 and $60 roughly. Now you say, well, how could that happen? Well, it happens. I know a lot of people think, well, with Europe going on and that sort of thing, but if you get into a serious type of downturn in the economy, oil will show it as well. Secondly, I should say, we'll talk about bonds here. Now, I went back and I wanted you to see this because it's important, but if you go back and look at the one-year U.S. Treasury yield, and this is over a 60-year period, by the way, the average has been about 6%. And so what happened, if you look at the end of this graph where the Federal Reserve, again, wrong move, left interest rates at such low levels that they really ruined the outlook for everyone. And now they started back up. We're talking about the one-year Treasury to a higher level. Do we think it goes to 6%? We don't know. But it certainly could go higher if you believe what the Fed is saying. And I suspect that we at least have a couple of more left in there. The other thing that's going on, and people right now are just hoping and begging the Fed's going to turn any day now and things are going to go back to normal. We'll have a great market, a great bond market, everything's great. That was the past history of 12 years. We think the next 10 to 12 years will be a different game because of inflation. But look at this graph. It will show you that the average time that the Fed is raising rates is about 28 months. We've only been in this one for 8 months. And the second part of this graph is the most important, which is if you take the Fed funds or the Fed's interest rates level and you subtract inflation, the average, they're usually over that number. In other words, the average is about 1.2%. Well, we're 6% below the Fed funds rate, 6% below what the inflation rate is. So one of two things has to happen, or maybe both. The rates go up and inflation comes off some, but we're not there yet. The other thing that's happened is you hear a lot about inversion or inverted yield curve. What that means is this. That means that the 2-year U.S. Treasury will pay you more than the 10-year U.S. Treasury. And I know that sounds odd because you go out further, but that's what happens when the Federal Reserve moves the rates. But you'll also see in this particular graph, and this goes back to 1965, that any time that's happened, or most of the time that's happened, you're going to see that you've had a recession soon after that. Average is about 14 months. We haven't been in it, we have obviously been in it for a while now. We've got a number of months, but we could go 2-3 quarters before you really see the really depth of the recession. So if you look at the market, one of the things about these next two graphs I find interesting is we had more money come into stocks and stock mutual funds in 2021 than the entire 17 or 18 years prior together. Now, if you look at here on the S&P 500 and look at the next one on the NASDAQ, all of those gains are gone. That means everybody that came in over the last 24 months is gone back to nothing. And most of them, you're going to see all of these are at losses at this point in time. That has an impact on people's sentiment and how they look at things going forward. Now, this is a graph we pulled off yesterday, but if you get Investors Business Daily newspaper, it comes out once a week, they do put in a mutual fund index. We like to look at it. You'll notice There's 20 of the biggest and largest stock mutual funds in the U.S. And some of them are world funds, but they're primarily U.S. And what you'll see is the average of these since January 1, this group is down 32.5%. Now that's a lot. I mean, it takes a long time to make up 32.5%. So just give you an idea of the damage that's gone on out there. Because what's happened in the marketplace is that we've gone, if you look at the S&P 500 down 23 through the first 9 months, you'll see the NASDAQ 31, 32. I mean, these are big numbers, okay, where the markets are down. One of the things we notice, though, is that people are not really doing anything about it. We don't see any margin selling. We see complacency, people not freaking out, saying, hey, I got to get out of the market, this, that, and the other. And I know why. It's because what you'll see is they've got accustomed to everything getting right back to normal and the Fed coming in and everything's good again. And we just don't think that's going to happen this time with inflation. What we do think could happen, and this graph looks, you probably don't know, most of you haven't been around during this period, but if you look at 1966 through the end of 1982, this is the Dow Jones average. It went nowhere. Whatever you invested in 66 was about the same price it was in 1982. You did get the dividends, I'll say that, but they don't do you any good in a high inflationary period because the inflation rate's 3 or 4 or 5 times more than the dividend, especially now. Look at the dividends now. You could very well see this go through over the next 8 to 10 years, 5 to 10 years, but it would be a different setup for a lot of professionals. They wouldn't be used to it because they haven't been around. So our themes leaving you with today are this. Number one, we cannot take all the risk out of a portfolio. Now we have really, I think, really good numbers this year relative to those 35 and 30% down numbers you're looking at earlier in this group. But still, no matter what you own, it's there. And let me give you an example. Had we as a firm at Oxbow gone in and said a year ago, so we're going to take everything and put it in, we're going to put everything we have in a 2-year treasury, 24-month U.S. treasury, 100% guaranteed, right there. You know what? You'd be down 4% today, almost 4, not quite, but right on the money, almost 4%, including the income. So I'm trying to give you an idea of why it's hard to manage in down periods, and you've got to manage the risk. You can't take it all out, but you can take a lot of it out, and that's why we have a lot of cash right now. Secondly, you need to maintain higher cash levels for the time being. One of the things we've done is our cash levels are the highest they've been since late 1999. It's paying off for us for this year. But the other thing we've done, and it's something that you have to look around at, but with the exception of 5 to 7%, we moved most of that cash into U.S. Treasury floating rate or U.S. Treasury 3-month to 6-month bills. The rates are much higher than the money market rates. We think that will eventually impact the money markets, impact the banks, but that's a money management thing you have to take a look at. But the key is risk management right here. If we go through and continue a bear market and it gets more and more and more severe, you have to maintain enough liquidity to keep your risk down, because that on the other side, this is what happens. It brings about some really fabulous opportunities. And with everything I've told you, while the news may look really negative to you, and it is, what it's starting to create, and think about this over the next 6 to 12 months, is one of the best buying opportunities you've seen, really, in probably 30, 40 years. And I think what happens in these super bubbles we have is they create a tremendous amount of downside. But if you have liquidity and you have cash all the while, it creates something and a setup for you so you can have some wonderful opportunities to buy some things that are really priced correctly. But having said that, I want to thank you really for coming, listening to what we've got to do here today, what we've talked about. Secondly, in a few days we'll have our market letter coming out, and you can follow up and see even some more detail on some of these subjects. But I want to thank you for being here. Our next video won't be coming out unless something really unusual happens until January of 2023. But if you have any questions or you want to talk to someone, certainly come to the website at oxbowadvisors.com. And thank you for listening in.